Monday was noise. I know that sounds dismissive after watching silver drop $3 in 12 hours, but Monday's price action taught you absolutely nothing about where this market is going. Tuesday's data teaches you everything. 5 pieces of information printed between Monday's close and Tuesday's Asian Open that fundamentally change the mathematical equation governing silver's next move. Monday was a shakeout. Tuesday is the signal. Let me show you exactly what changed overnight because the numbers that just came in are staggering. The first thing that changed: COMEX registered inventory broke 82 million. Monday morning, registered silver was 83.1 million ounces. Tuesday morning, it is 81.4 million ounces. 1.7 million ounces withdrawn in a single session during a day when the paper price dropped $3. Think about that for a second. Price fell, and physical metal left the vault faster than any day last week when price was rising. If Monday's decline represented genuine selling, meaning people actually wanted to exit silver, you would see metal flowing into vaults, not out. Sellers deliver metal back to the exchange. That increases inventory. Instead, inventory collapsed by 1.7 million ounces, which tells you the people who moved metal on Monday were not selling. They were buying at the manufactured discount and removing their metal from the COMEX system permanently. The coverage ratio just dropped to 1.5 to 1, 54.2 million ounces of March delivery demand against 81.4 million ounces of registered stock. The historical average coverage ratio is 4.2 to 1. The February 2021 squeeze low was 2.3 to 1. We just broke that record by a mile. There are still 1,712 open March contracts representing 8.56 million ounces that have not declared intent. If half of those stand, the coverage drops to 1.37 to 1. If all of them stand, it drops to 1.3 to 1. The exchange is operating on a margin of approximately 27 million ounces between registered stock and delivery demand. At the current drain rate of 1.7 million per day, that margin evaporates in 16 trading days. March 27th is first notice day for April contracts. 16 trading days from now is April 1st. The March and April delivery cycles are about to overlap with less than 80 million ounces standing between the exchange and a delivery failure. The second thing that changed: Shanghai premium hit 1620. The Shanghai physical premium over COMEX spot price expanded to $16.20 during Tuesday's Asian session, new all-time record, broken for the third consecutive day. Monday it was $15.40, Friday it was $14, Thursday it was $12. The premium is accelerating by approximately 80 cents per day. At that trajectory, Shanghai physical silver will be trading at a $20 premium over COMEX by Friday, March 14th. $20 of premium means the real transaction price for physical silver in China is $102 per ounce, while the COMEX screen shows 82. The paper to physical divergence is approaching 20%. There is no historical precedent for a sustained 20% divergence between paper and physical pricing in any major commodity market. The last time divergence approached this level in any metal was palladium in 2019, when the spread triggered a 200% price increase over 14 months. The arbitrage mechanics are accelerating the drain. Net profit for buying COMEX silver standing for delivery and shipping to Shanghai is $14.45 per ounce after all costs, $7.2 million profit per 100 contracts. Arbitrageurs are filing delivery notices as fast as the exchange allows. This is why delivery demand increased from 52.63 million ounces on Friday to 54.2 million ounces on Tuesday, despite the paper price declining. The lower the COMEX paper price goes, the wider the Shanghai premium gets, and the more profitable the arbitrage becomes. Pushing price down accelerates the inventory drain. The people suppressing paper price are destroying their own exchange's inventory in the process. The third thing that changed: the oil-silver correlation crossed zero. I have been tracking the 30-day rolling correlation between WTI crude oil and silver since the Strait of Hormuz closure on February 28th. During the initial oil shock, the correlation went deeply negative as silver sold off alongside equities while oil surged. That negative correlation peaked at negative 0.31 on Friday, March 7th. Over the weekend, the rolling calculation started shifting. Monday, it hit negative 0.12. Tuesday morning, it crossed zero and is now at positive 0.08. The correlation has officially flipped from negative to positive. This matters enormously because it means silver will now start tracking oil higher instead of diverging lower. WTI crude is holding above $115. Brent is above 92. Oil analysts at Goldman Sachs project 125 by end of March if the strait remains closed. A $10 move in oil from current levels with a positive 0.5 correlation coefficient, which should be reached by Thursday, projects a $7 to $9 sympathetic move in silver. That calculation alone puts silver at 89 to 91 by end of March. Add the COMEX delivery pressure and the Shanghai premium reconciliation, and the upside expands further. The correlation flip is the missing piece that transforms all the bullish fundamental data into actual price movement. The fourth thing that changed, CME open interest data. Monday's final open interest data showed a decline from 76,948 contracts to 74,800 contracts. Open interest declined by 2,148 contracts on a down day. This is the most important piece of confirmation data that the Monday sell-off was forced liquidation, not new short selling. When open interest declines on a price decline, it means longs are exiting. When open interest increases on a price decline, it means new shorts are entering. New shorts entering would be bearish because it means fresh capital is betting against silver. Longs exiting is bullish because it means the selling is finite. Every long that exits is one less seller in the market. When the last forced seller exits, the only remaining participants are buyers. Monday's volume was 38,000 contracts. Friday's volume was 42,000. Declining volume on a declining price with declining open interest is the textbook definition of selling exhaustion. The market is running out of sellers. When the sellers are exhausted, the buyers who have been absorbing the selling at $80 to $82 take control and price reverses. The volume signature suggests the exhaustion point is either today or tomorrow. The fifth thing that changed, the deficit recalculation. The Silver Institute updated their quarterly demand data Monday evening. Industrial silver demand for Q1 2026 is running at 298 million ounces on an annualized basis. That is higher than the previous estimate of 286 million ounces. The increase is driven by accelerated solar panel manufacturing in Southeast Asia and increased AI data center construction in the United States and Japan. The revised annualized industrial demand of 1,192 million ounces against total supply of 1,050 million ounces puts the revised structural deficit at 142 million ounces. Previous estimates ranged from 67 to 117.5 million. The deficit just got worse, significantly worse. 142 million ounces is 13.5% of total annual mine production. The market has never sustained a deficit exceeding 10% of production without a major price adjustment. The solar demand component is particularly stubborn. Despite price increases from $32 in late 2024 to $82 today, solar manufacturers have not reduced silver consumption per panel at scale. The thrifting technology that JP Morgan cites as justification for their conservative forecast is not operational in mass production. Longi and Jinko Solar confirmed in their Q4 2025 earnings calls that silver reduction targets were delayed from Q1 to Q3 2026 due to efficiency losses in test production. That means for the next 6 months at minimum, solar silver demand remains at current elevated levels. 6 months of 142 million ounce annual deficit is 71 million ounces of additional depletion from a market that is already running on fumes. Why Tuesday matters more than Monday. Monday's $3 drop told you that paper contracts can be sold to push price lower. You already knew that. Tuesday's data tells you that the physical market responded to that paper selling by accelerating metal withdrawals from COMEX vaults. It tells you Shanghai buyers raised their premium to new all-time records. It tells you the oil correlation flipped positive, removing the macro headwind that suppressed silver for 10 days. It tells you the forced sellers are nearly exhausted based on declining volume and open interest. and it tells you the structural deficit is wider than anyone previously estimated. Monday was the last act of a liquidation cycle that began with the CME margin hike 3 weeks ago. That cycle destroyed leveraged longs. It eliminated speculative froth. It crushed open interest to the lowest level since September 2025. It accomplished everything the paper market needed to accomplish. And despite all of that destruction, the physical market emerged stronger. Less inventory, higher premiums, wider deficits, more delivery demand. Tuesday is day one of the next phase, the phase where physical reality reasserts control over paper fiction. The phase where $82 COMEX silver reconciles with $98 Shanghai silver. The phase where the oil correlation transforms the energy crisis from a headwind into a tailwind. The phase where exhausted selling gives way to fresh buying from systematic capital freed up by the margin reduction. The exact level that confirms the phase shift is a daily close above $84. That reclaims the 21-day VWAP flips algorithmic bias from sell to buy and positions silver for an immediate test of 86 to 88, where the next wave of institutional buying activates. Monday could not give you that close because Monday was the exhaustion day. Tuesday can. If 84 prints on today's close, the reversal is confirmed, and Wednesday through Friday become the acceleration phase targeting 92. Forget Monday. Monday was designed to scare you. Tuesday is designed to inform you. The data that printed overnight is the most bullish 24-hour cluster I have tracked since the 63.90 bottom in February. Silver rallied 53% from that bottom in 17 trading days. The setup today is structurally identical with tighter inventory, wider premiums, deeper deficits, and now a positive oil correlation that did not exist in February. This is Silver Eye. Tuesday is the day that matters. I will be back tonight with the closing analysis. If 84 confirms, the acceleration video goes live within the hour, notifications on. Do not miss it.